Welcome to this video on avoiding costly mistakes with partial year HSA contributions. Today we will clarify the pro-rata rule, show you how to calculate your exact contribution limit month by month, and explain the high-stakes last month rule. We will also cover common pitfalls and walk through examples so you can contribute confidently and avoid IRS penalties. Now, let's outline what we'll cover. Here is the plan for today. First, a quick refresher on why HSAs are powerful. Second, we will detail the pro-rata trap and how monthly eligibility works. Third, we will calculate your exact limit step by step. Fourth, we will highlight coverage pitfalls to avoid. Fifth, we will explain the last month rule and its testing period. Sixth, we will show examples and diagrams. Seventh, we will include brief quizzes. Finally, we will summarize key takeaways and next steps. With that roadmap in mind, let's get started with an HSA refresher. Health savings accounts can be a remarkably efficient tool because contributions can be tax deductible, growth is tax deferred, and withdrawals for qualified medical expenses are tax-free. This combination creates a rare triple tax advantage. However, to capture these benefits safely, you must contribute within the IRS rules and limits, which is especially important when your HDHP coverage is not for a full year. Next, let's expose the pro-rata trap that catches many people off guard. The pro-rata trap is simple but unforgiving. You are not allowed to contribute the full annual HSA maximum if you are not eligible for all 12 months. Eligibility is determined month by month based on whether you had qualifying HDHP coverage on the first day of each month. Your personal contribution limit equals the annual IRS limit divided by 12, multiplied by the number of months you were eligible. If you contribute more than that amount, the excess may be taxed and penalized unless corrected by the deadline. Now that you grasp the trap, let's visualize the calculation flow so you can apply it correctly. This flowchart shows the monthly eligibility process. For each month, ask whether you had qualifying HDHP coverage on the first day. If yes, count that month as eligible. If no, do not count it. Repeat this for all 12 months to get your total eligible months. Next, compute your monthly limit by dividing the annual IRS limit by 12. Multiply that by your total eligible months to find your personal cap. Finally, compare your planned or actual contributions to this cap. If you exceed it, remove or reclassify the excess before the tax filing deadline to avoid taxes and penalties. With the visual in mind, let's turn the steps into a simple checklist you can follow. Here is a simple process. First, determine your tax year and verify the correct annual IRS HSA limit for self-only or family coverage. Second, list all 12 months and mark whether you had qualifying HDHP coverage on the first day of each month. Third, confirm you did not have disqualifying coverage, such as a general purpose, FSA, or a non-HDHP spousal plan. Fourth, count only the eligible months. Fifth, compute the monthly amount by dividing the annual limit by 12 and then multiply by your eligible months. Finally, compare your planned or actual contributions to your computed cap and remove any excess before the tax deadline if necessary. Next, let's walk through a concrete example table so you can see how the math plays out. In this example, the person had no HDHP coverage in January and February. From March through August, they had HDHP coverage on the first of the month. In September, although HDHP existed on the first, they had disqualifying spousal non-HDHP coverage, so September is not eligible. HDHP was present, and no other disqualifying coverage in October, November, and December, so those months are eligible. Eligible months are March, April, May, June, July, August, October, November, and December, totaling 9. The personal contribution limit equals the annual IRS limit divided by 12 times 9. Replace the annual limit with your tax year's numbers. Now, let's discuss coverage pitfalls that can unexpectedly disqualify you. Several coverage pitfalls can disqualify HSA eligibility. A general purpose FSA, whether your own or your spouse's, can disqualify you. Non-HDHP spousal coverage can also break eligibility, even if it is secondary. Medicare enrollment usually ends HSA eligibility. Certain gap or supplemental policies may disqualify you. Only specific permitted insurance such as limited dental, vision, or accident coverage is acceptable alongside an HDHP. Lastly, remember that the first day rule uses the first day of the month to determine eligibility. Mid-month changes do not make that month eligible unless you were eligible on the first and had no disqualifying overlap. With pitfalls covered, let's compare the monthly rule to the last month rule strategy. On the left, the monthly rule. Your limit equals the annual limit divided by 12, multiplied by the number of months you are eligible. This approach is straightforward and lower risk, especially when coverage is sporadic. On the right, the last month rule allows you to contribute the full annual maximum if you are HSA eligible by December 1st, but only if you remain eligible for every month of the following calendar year, known as the testing period. If you fail that testing period, the excess becomes taxable and may be subject to penalties. With the high-level comparison in mind, let's visualize the testing period timeline. This timeline illustrates the last month rule. If you enroll in an HDHP by December 1st, you may contribute as if you were eligible for the entire year. However, you must then remain HSA eligible for each month of the following calendar year. Any break in eligibility during that testing period can cause the excess portion of your contribution to be included in income and potentially subject to penalty, and earnings on that excess may be taxed. Now let's broaden the picture with a mind map of allowed versus disqualifying coverage types. This mind map distinguishes permitted coverage that can coexist with an HDHP from disqualifying coverage that breaks HSA eligibility. Under permitted, examples include limited purpose FSAs, dental or vision-only plans, accident-only policies, and certain fixed indemnity policies. Under disqualifying, examples include a general purpose FSA, a non-HDHP spousal plan that covers you, Medicare, certain TRI care options that are not HDHPs, and general gap coverage. Keep in mind that plan specifics matter, so always verify details. Next, let's reinforce learning with a quick quiz. Question: you started HDHP coverage on April 1st and lost it on September 15th with no other disqualifying coverage. How many eligible months count for the monthly rule? Options: A. 5 months April through August. B. 6 months April through September. C. 7 months April through October. D. 4 months May through August. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 6 months, April through September. The first day rule counts the month based on eligibility on the first day, so September is included, even though eligibility ended mid-month. Now that we've tackled the monthly rule, let's test your understanding of the last month rule. Question: under the last month rule, you enroll by December 1st and contribute the full annual maximum, but you switch to a non-HDHP in June of the following year. What happens? Options: A. Nothing changes. B. Only earnings on the excess are taxed without penalties. C. The excess becomes taxable and may be subject to penalty. D. You can fix it by relabeling the contribution as next year's. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that the excess becomes taxable and may be subject to penalty because you failed the testing period by breaking eligibility during the following year. Earnings related to the excess may also be taxed. Next, let's present a quick pie chart to visualize eligible months in our earlier example. This pie chart represents the earlier example with 9 eligible months and 3 not eligible. Your personal ratio may differ based on your coverage timeline and any disqualifying factors. Always compute using your year's actual HDHP status on the first day of each month. With visuals complete, let's capture the core ideas you should remember. Here are the key takeaways. First, use the monthly rule by default, and only consider the last month rule if you fully understand the risk and can remain eligible for the entire testing period. Second, count only months where you had HDHP coverage on the first day and no disqualifying coverage. Third, compute your limit as the annual IRS limit divided by 12 times your eligible months. Fourth, correct excess contributions before the tax deadline. Fifth, double-check spousal coverage, FSAs, Medicare, and any gap or supplemental plans. Finally, when in doubt, consult IRS Publication 969 or a qualified professional. Before we wrap up, here is an important disclaimer. Disclaimer: this content is educational and does not constitute tax, legal, or financial advice. IRS rules and limits can change. Verify the current year's limits and guidance, including IRS Publication 969 and relevant instructions, and consult a qualified professional for your specific situation. With that in mind, let's summarize and close with next steps. To wrap up, HSAs are powerful, but partial year contributions require precise pro-rata calculations. Monthly eligibility is determined by whether you had HDHP coverage on the first day of each month. Watch for disqualifying coverage such as a general purpose FSA, a non-HDHP spousal plan, or Medicare. The last month rule allows full year contributions if eligible by December 1st, but you must pass the following year's testing period. Calculate carefully, verify your status, and correct any excess as early as possible to avoid penalties. Finally, let's end with a call to action. Thank you for watching. If this helped you avoid overpaying, please like the video, share it with someone who recently changed jobs or health plans, and subscribe for more practical guides. What questions or experiences do you have with HSAs and partial year eligibility? Share your thoughts in the comments, and we will try to help in future videos.